Welcome to Investing Insights. I'm your host, Ivana Hampton. The revenue of U.S.-based dividend stocks isn't necessarily made in America. A portfolio of popular dividend-paying stocks is likely exposed to currency or geopolitical risk, and that's due to international revenue exposure. Some U.S.-based companies earn 50% or more of their money outside of the country. A recent analysis of 35 dividend-paying stocks in Morningstar's DividendInvestor newsletter found several well-known names generate sizable revenue overseas. So, how should investors balance U.S. versus non-U.S. equity exposure? Morningstar's DividendInvestor newsletter editor, David Harrell, explains what investors should know. Thanks for being here, David.
Great to be back.
Well, you recently analyzed the international revenue exposure of dozens of dividend-paying stocks, but this wasn't the first time. Why did you decide to revisit this?
Sure. This is an exercise I first did back in 2021, I believe, and I wanted to revisit it. As you know, there's not really a broad consensus on how much exposure U.S. equity investors should have to international equities. Now, if you were trying to create sort of a market-neutral portfolio, you'd have a pretty large exposure, more than 30%. I believe our colleague Amy Arnott recently had a piece, and she pegged the number at 37.7% based on current market capitalizations of U.S. versus non-U.S. stocks. But I would say 37% is probably a higher exposure than almost every individual investor in the United States has. On the other hand, you have some very well-respected folks like the late Jack Bogle, founder of Vanguard, or Berkshire Hathaway CEO Warren Buffett, or at least CEO through the end of this year, who have long made the case that U.S. investors don't need direct exposure to international stocks. And their reasoning there is that many U.S. companies are actually generating a large portion of their revenue overseas. If you take the S&P 500 index, for example, the five largest stocks in the index, Microsoft, NVIDIA, Apple, Amazon, Meta Platforms, all of them generate a significant portion of their revenue outside of the US. Several of them actually generate more revenue outside of the US than in the United States. So the logic there is, hey, you're getting this exposure already. If you own a S&P Index 500 or just a diversified portfolio of US stocks, you probably have a fair amount of international revenue. So really what I wanted to do was to just really check for the portfolio that's featured, the dividend stock portfolio that's featured in our newsletter, how much of its revenue was being generated outside of the US.
Let's dissect the investigation. How did you choose which stocks to focus on, and what was the criteria?
Well, actually, I didn't make any choices there. I was just using our portfolio, which was around 35 stocks at the time. And to do this, I used actually a Morningstar tool, our PitchBook platform. If you go in there to look at income statements, there's a tab for segments, and you can break that down by segment of where the revenue is coming from. Now, there's a couple caveats here. And the first is that as far as I know, there's no regulatory or accounting practices standard for U.S. companies as far as how they have to disclose this information. So what it turns out to be is that you have a large sort of variation in what companies do. So some firms are just providing a U.S., non-U.S. breakdown, while others might provide percentages for dozens of regions or individual companies. The other caveat here is that it's always going to be, depending on where you are in the year, firms have different fiscal calendars, fiscal years. So it's going to be a mixture of fiscal years. So I would guard against false precision in any type of analysis like that. But if you look at dividend-paying stocks in general and sort of the sectors that they're coming from, you're going to have some sectors and industries, consumer packaged goods, for example, which tend to have a fair amount of international revenue exposure. Some of the big pharmaceutical companies, the same thing. But then you have utilities and such, which are generally popular with dividend-seeking investors. And most of those, unless it's a non-U.S. utility, all of their revenues generated in the United States, or maybe even a specific region or an individual state in the U.S.
How did the recent results compare to the findings in 2021, and were there any surprises?
No. So for both times I did this, 21 and just over this summer, what I found was, there's a broad mix, there's a broad range within the portfolio. You have some companies with 100% of their revenue generated outside of the United States, such as Philip Morris International, as its name implies. It's a U.S. company, but it's all international revenue. And then some that have 0% within the US. But in 2021, it was about a 70-30 split on a weighted average of US versus non US revenue. And in 2025, which was mostly based on fiscal year 24, I saw a slight increase. It was an international, more of a 68 to 32% US versus non US. But not really significant. Again, I'm guarding against false precision here. And there were several changes in the portfolio from 4 years ago as well.
Let's zoom in on revenue. Which dividend stocks increased or decreased their U.S. revenue exposure?
Some of the largest changes in terms of increased U.S. exposure were for Texas Instruments, Pfizer, Coca-Cola, and ExxonMobil. And then a couple that had sort of the largest increase in international exposure were Genuine Parts, which manufactures automotive parts, and Amgen, the pharmaceutical company.
Now, Morningstar considers some of these dividend payers undervalued. Let's first focus on the names with more U.S. revenue exposure. Who are they?
Sure. So in terms of undervalued stocks that are companies that generate all of their revenue in the U.S., I point to Edison International, which its name is something of a misnomer because it's a California-based utility generating all of its revenue in the United States. I'm not sure where the international came from, but that company is currently trading at about a 31% discount to its Morningstar fair value estimate. Another name would be Verizon, and it's generating 100% of its revenue in the US as well. And that's trading at about a 17% discount to its fair value estimate.
Now, which companies with more international revenue exposure are undervalued?
Sure. Pfizer, for example, even though it did increase its US exposure, it's still generating about 40% of its revenue outside of the United States. And it's trading at a large discount to its fair value estimate, around 34%. Another pharmaceutical name would be GSK. Now, that's in our portfolio, but it is a London-based company, but it generates about half in the US, half outside the US, and that's trading for around a 30% discount as well. And then Omnicom, which is the ad agency or ad agency conglomerate, which is a similar type of thing, about half its revenue outside the United States, and it's trading at around a 32% discount to its Morningstar fair value estimate.
Now, international stocks are having a long-awaited banner year versus U.S. stocks. Are investors whose only international revenue exposure to these U.S.-based stocks benefiting from the international rally?
Not necessarily. As Christine Benz, Director of Personal Finance here at Morningstar, every January she puts together her expert predictions for asset class returns. And it's kind of a Groundhog Day thing, it seems like to me, because it's always U.S. stocks are expensive relative to non-U.S. stocks, by valuation measures such as price earnings or price ratio with Morningstar fair value estimates. So from an academic standpoint, it's always been like, well, U.S. stocks are probably going to underperform international stocks. But U.S. stocks have been chugging along every year pretty much since the global financial crisis of 2008 and 2009. But as you said, this is the year we finally have seen a reversal of some sorts. So I think the Morningstar Global Markets Index is around 23% year to date through earlier this week, while most broad-based U.S. market indexes are only around 10% year to date, so about half of that. So the question is, though, does having heavy non-U.S. revenue exposure help companies more likely to benefit from those trends? And it doesn't really seem to be the case. Now, obviously, with individual companies, it's some are up and some are down. But the folks at DFA, Dimensional Fund Advisors, did some research published last year, which sort of suggested that U.S. companies tend to move with the U.S. market, at least as a group. So either U.S. companies with a lot of international revenue exposure, U.S. companies with zero U.S. Non-U.S. revenue exposure, they tend to move with the U.S. market, not the international markets. And the conclusion there was that if you want to get the diversification value of non-US or international stocks, you need to own those stocks directly. That, this is an interesting exercise that you can do to sort of come up with, hey, I've got X% non-US revenue. And that might have implications, for that individual company's performance. But in terms of benefiting from either diversification or outperformance from non-US stocks, it doesn't seem to be the case.
How should investors balance their U.S. equity exposure versus their non-U.S. equity exposure? That is, what if they're looking in their portfolio and they see that they have home country bias? What should they consider from a diversification standpoint?
Sure. Well, our colleague Amy Arnott had a recent piece on Morningstar.com, and she was making that argument that from a diversification standpoint, you really do need to have direct exposure to international stocks, either by owning those stocks directly or through an international ETF or mutual fund. As far as the percentages, I'm not going to necessarily say you go to market neutral, which is a really large percentage, but a significant, at least a reasonable amount there. Now, if you start thinking about this from a valuation standpoint, as far as you're putting new money into the market or you're rebalancing your portfolio, Dan Lefkowitz from our indexes team has a recent piece and has pointed out that even after the relative outperformance of international stocks in 2025, this double the total return of the U.S. market, by most valuation metrics, those stocks are still relative bargains compared with U.S. stocks. Now, again, we're talking at the country level. So for any region, U.S. or non-U.S., at any time, you're going to have U.S. stocks that are undervalued, and then you're going to have international stocks that are overvalued. So it's not just a case of buying an international stock versus a U.S. stock. So you're always going to want to consider things like valuation, moats, and so on. There's one other thing I did want to touch on, though, and it sort of gets back to the previous question in terms of U.S. investors benefiting from the relative performance of international stocks this year. As Dan noted in his piece, what we've seen is a falling U.S. dollar in 2025. So that's created a tailwind of sorts for some of these international stocks. But when we think about dividend investors who own these non-U.S. stocks, either directly or the ADR shares of them. So these stocks, they're paying their dividends in a non-U.S. currency, in a Swiss franc or a euro, British pound, or so on. Those currencies are all appreciating relative to the U.S. dollar. So when those dividends are paid in their base currency, and then exchanged to US dollars for the payout for the US investors, they're actually getting a little boost right now in each dividend payment because of that weakening US dollar or the strengthening of the non-US currencies. Now, a couple things to keep in mind here is that when you own these stocks, you're often paying a small ADR fee with each dividend payment. And if you look in your brokerage account, unless the US has a tax treaty with that company, you're often seeing taxes withheld from your portfolio or from the dividend payment. So you'll actually see the dividend payment, and then in red, you'll see tax withholding. And that tax may be recoverable when you file your taxes for the year. But if the stocks are held in a tax-deferred account, such as a 401k, brokerage window, or an IRA, they might not be recoverable. So that's something to keep in mind. But I would consult with your tax professional for that.
Tax professional, CFP, and the rest of the team. David, thank you for coming to the table and talking about international revenue exposure and dividend stocks.
Thanks for having me.
We have a special guest on Investing Insights this week. Morningstar CEO Kunal Kapoor is here to talk about his monthly series, Investors First, and the mission behind it. One of our company's core values is, quote, champion the investor. And that involves helping everyday folks make confident and informed decisions along their financial journey. I spoke with Kunal about his Investor First series before it debuts live on YouTube in September. Welcome to Investing Insights, Kunal.
Thanks for having me.
So let's get started with you telling the audience a bit about your career here at Morningstar. It started in the late 90s, right?
It did start in the late 1990s, believe it or not. And I was a mutual fund analyst for many years. And so I covered many of the investments that people probably are familiar with. And I worked with many of our analysts to this day. And then kind of moved over to other parts of the Morningstar business until I ended up in my current role.
Cool. So your series, Investor First, is going to air live on YouTube for the first time on September 10th. Can you talk about the mission behind it and what you're hoping investors get out of it?
Yeah, Morningstar's entire mission is about empowering investors. And so every month we've tried to bring different investors and different viewpoints that are maybe slightly out of the mainstream. It's not about what's happening in the markets every day or, what fund should you buy or what stock looks good at any given moment. It's more about how you should be thinking about things in the context of the next 3 and 5 years. And we've attracted and spoken to many industry luminaries and many Morningstar luminaries. And so it's kind of been a fun project for me as well, because I'm an investor at heart and I care about these topics myself. And so I get to have a little bit of fun and talk to some folks in a longer format myself.
So it's important to have these conversations with investors. What can Morningstar do to further empower them?
Well, there's a little bit of the more things change, the more they stay the same. And there's a little bit of it that isn't that way. And so we always have the task of keeping investors focused on their goals. And that's an evergreen task in helping investors achieve those goals and empower them in a way. But the world does change. There's more personalization, there's more choice, there's the convergence of public and private markets. And so what you were investing in 15 years ago may not be entirely representative of what you invest in 15 years. And it's Morningstar's job to be side by side with you as you're on that journey and to advocate for you. So, for example, if private markets become more mainstream, part of what I think our job will be to bring more transparency, to help shine a light on fee structures, to talk about things such as liquidity. It's a whole new ballgame. And what better partner than Morningstar?
Excellent. So investors have experienced a lot of short-term volatility this year. How should they stay focused on those long-term goals?
Well, let me tell you, there's always short-term volatility. There's volatility every day. Markets open, something's up, something's down, and someone will find a news angle to write something about why something is up or down. Really, most people just should not care about what's happening on a daily basis. I certainly don't. It's fun in sport to watch, are your stocks moving up? Did your mutual fund do well? What happened to your ETF? But there's a reason private market investors have also been successful, because they take a longer term view. And even in the public markets, if you look at some of the most successful investors, I can tell you that Warren Buffett doesn't wake up in the morning and say, oh my God, I better check the price of Coca-Cola today. And so the key thing is to have great goals and to be focused on achieving those goals. So when you're writing that first check to send your kid to college, or when you're thinking about your retirement, or maybe you're putting a down payment on a house, you feel great. And it's Morningstar's job to help you with those goals and not to care about, is the interest rate going to go up today or not? Is my stock going to be up 3% today or not? It just does not matter. And so stay focused on what matters. That's what we're here to help you with.
I feel more at ease already.
Good.
Well, everyone listening and watching, Investors First is going to debut live on Morningstar's YouTube channel on Wednesday, September 10th. So do yourself a favor, set a reminder. Kunal, thank you for coming to the table.
Absolutely. Thanks for having me.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. First, give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And second, subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor, Morningstar. Take care.